Well, the volatility in the stock market is definitely leveling off for now. This whole week, we've had smaller moves, small compared to last week's massive moves that we had, massive downside and upside shifts, double digits in both, both directions. One day, you were over 10% up, and then the next day over 10% down, and so on. But this week, things seem to be stabilizing a little bit, and we've been locked in this range of 2,300 to 2,450, which 2,450, of course, is a very big, important number because that was, the 2018 lows. I believe the intraday low was something like 2,436, if I remember correctly. And so this has been you need a decisive move below this number to confirm that we're going to keep moving down in stocks in the short term. Because of course long term I still think fundamentally, economically we're screwed. But it's as far as following the day-to-day of the stock market of how things are moving. There is room for a relief rally here because you've got major support. And so I've been going back and forth on this whole week whether I think it's going to break up or break down. And it is telling that the market has not been able to reclaim, and of course when I'm talking about 2450, I'm talking about on the S&P 500, just to be clear. That's just the index I choose to focus on. You can also look at other charts, but that's what I've been following as a proxy for the broader market. And to me, and again, I'm not a trader, so this is just something I'm doing for fun because I'm more interested in the economics of it. But I have to follow the stocks day to day just to get the most, I guess, up to date view of it. I'm looking at the micro here, but this is not my specialty by any means. So this is just my amateur take as far as this part's concerned. But it seems telling to me that the market has not been able to reclaim 2450. That every time we go up to retest 2450. To try and break above it, the market seems to have rejected that. So while we are locked in a bit of a range here, it is a range below, that support level, below the high end of that support level. Because you could say obviously the support levels are always a range really, but 2450 is the upper end of that. Is the upper end of where that support should be. So it's not like it's bouncing off of support and it's hitting 2450 and bouncing above it every time and seeing if it's going to go below before 2450. We're below 2450 now. And so the market seems to be waiting things out to get some major news. I think that if you have a major positive or negative headline, that's going to push us out of the zone, it would seem. So to me, it still seems like it's open whether it could go up or down, whether we get a really good headline, and by good, I mean good from the market's perspective, like, say, the announcement of, hey, the bailouts are here, the checks are in the mail, Boeing's been bailed out, the airlines have been bailed out, everyone got their money, everything's been passed, and of course there is all this stimulus stuff working through Congress right now. And so I think that maybe that might be what the holdup is here, that the market is sort of hesitating because it sees all this stuff going on with Congress, and so it's waiting to see what's happening. Now, that's not to say that necessarily once a stimulus deal actually does pass, is confirmed to pass, that the market's going to shoot up and break back above the support level and reclaim these a level above 2450. I think that it's very possible that the selling has stopped in anticipation for that, so that they can sell the news after this happens. That it's the anticipation of this this stimulus package that's keeping people in the market. It's the old saying, buy the rumor, sell the fact. And so once the fact is here, and Trump has signed the package, we may in fact see a sell-off, because that's what we have seen every time that the Fed has taken action. The market has rallied, throughout last year on hopes of the Fed, ending the runoff of its balance sheet, on hopes of the Fed cutting rates. But every time the Fed actually took any action, the market sold off because those actions were already priced in to the market. And so once they occurred, then that hope no longer existed because it had already come to pass, so everyone sold. The market, or the Fed, these interventions, whether they come from the government or the Fed, seem to be driving short-term traders to act, not long-term investors. Okay, because a trader is the kind of person who's going to buy the rumor and sell the fact. Okay, because they're just waiting for the jump that's going to come as a result of that news. But then once that's over, they have no reason to hold on to that position because they want to cash out on their gains. And so I guess that's really what's going to determine this, is who is driving this range. Is it the traders or the investors? If it's the traders who are running this, then I think it seems to be a very strong possibility that you're going to see a sell-off once anything gets through Congress. And, I don't know if that'll come by the end of the week. So I'm going to hold off talking any more on that, other than to say that I think that I haven't talked about the politics of this whole situation very much at all. But one political aspect is that if you remember after 2008 when the bailouts first occurred, okay, before people, really, this had never happened before and there was no real opinion of it, it was received very negatively. Even though during the crisis it was sold as, oh my God, we have to do this or else the world's going to end tomorrow. And then people bought into it for a second, but then very quickly folks soured on the idea of bailouts. And so on the left, you got Occupy Wall Street, and on the right, you got the Tea Party. These were both responses to the 2008 financial crisis, the bailouts and everything. These were populist uprisings, which preceded the rise, respectively, of Bernie Sanders and Donald Trump. And of course, I don't necessarily mean in terms of ideology. I'm not saying that the ideals of the Tea Party in 2010 line up with Donald Trump's 2016 platform. Not at all. I'm saying that the spirit of what people felt was embodied by Sanders and Trump, respectively. The roots of their bases come from those two movements. And so now you're going to have a new generation of those sorts of people who are going to be radicalized, let's say, by this new round of bailouts. And the problem for Donald Trump is that he ran as the anti-establishment guy. He is the kind of person who is supposed to, be the opposite of the folks handing out these bailouts and giving big literal handouts to corporations who made very bad decisions and deserved to go bankrupt. Jeff Gundlach, the Bond King, as everyone agrees, a very rich man, the founder of DoubleLine, had put it pretty succinctly on Twitter, and he said, I don't think that the bailouts of large corporations that were over-leveraged and were specifically over-leveraged because they were doing share buybacks to try and boost the incomes of CEOs and hedge funds is going to roll too well with the American people. That this is going to be spark outrage from people, that these companies like Boeing and these airlines and all the other companies, because it's not just those companies, it's all the other ones. These are just the ones who are going bankrupt first as a result of the virus. These are the ones who are getting hit most directly by the virus. But everyone else has the same problem. Really, this is really a widespread issue in corporate America. And so people aren't going to take too kindly to these folks, these very irresponsible business leaders being bailed out, because it really is, 2008 2.0. This is just as bad as it was back then. And people, already don't like bailouts. The bailouts are still not popular from all that time ago. So you're going to try and convince people now that bailouts are good? And bailouts had bipartisan disapproval, and they still do now. I think that politically, this is going to have this is not only going to hurt Trump, but this has the potential of inflaming, divisions in this country, not between the left and the right necessarily, but just between, people and their government, which of course is the exact kind of division that I like to foster. I think that people should, be opposed to their government because, their government does a lot of bad things. And so if we have all these bailouts happening with the backdrop of a total economic collapse, and people see their standards of living fall precipitously, which, hey, don't get me wrong, even if the government is cutting people $1,200 checks, which is what Mitch McConnell's talking about now, that's not going to alleviate the decline in standard of living from the material collapse in production in this country. If things just aren't being produced, no amount of money is going to replace those goods. And so if people are hungry, even if it's not in a physical sense, but if they're hungry in an emotional sense, if they feel like they've lost so much and they see, again, the bailouts coming out, folks are not going to take kindly to that. You're going to see probably unrest. You're going to see folks who are going to be breaking the quarantine and trying to protest. You're going to see a lot of resistance to things that the government is going to try and implement in the midst of this crisis. And so Trump and the Feds may be shooting themselves in the foot by taking this sort of attack now, because later on I think they're going to need that confidence and respect from the American people. And by doing the sorts of things that they're doing now, they're discrediting themselves. Now, aside from just the actual bailouts by Congress, which are going to be paid for with Treasury bonds, bonds that will be issued by the U.S. government and then purchased through the primary dealers by the Fed. So essentially, that's debt monetization through the Fed. That's how these bailouts are going to be conducted. We also got something this week, which I missed at first. I knew that the Fed had approved this special vehicle, they call it, through which they can purchase commercial paper, which is short-term corporate debt. So this was a way of trying to help the big corporations from going bankrupt too quickly. That's essentially what they were doing. This is short-term liquidity, less than a year. That's what the Fed decided to buy now, in addition to Treasury bonds. And technically, they're not purchasing them. I think the way they count it is that these are being used as collateral for loans, but they're moving them onto the Fed's balance sheet. So what I missed is that in that same document in which they approved purchasing commercial paper, they also approved purchasing equity securities, which are stocks. Now, I haven't heard too many people talking about this. You would think that'd be bigger news than just the corporate paper, because if the Fed, is able to purchase from the primary dealers, by the way, which are banks like Goldman Sachs and Morgan Stanley and J.P. Morgan and those sorts of banks. The real big guys, the guys who will never go under because literally they are one step removed from the Fed. That's why people don't really understand that the banking system is not, the banks are not at all like representative of capitalism or anything like that. It's, you have this weird public-private, privatized profits and socialized losses system, which the bailouts represent, but the banks in particular are quasi-governmental institutions. They've been cartelized since really the Civil War in this country, and so you can't look at your local bank, or I shouldn't say at a national bank in particular, in the same way that you would look at a company like McDonald's or your local hardware store or something like that. The banks are very closely linked to government policy. So anyway, if these banks are buying up they have a lot. Let's say Goldman Sachs. Goldman Sachs is an investment bank. They own a lot of stocks, and these stocks have just plummeted in value. Well, the Fed now has the ability to go and buy those stocks from Goldman Sachs at the price that they were worth a month ago. And so in doing so, that gives Goldman Sachs all their money back. It recuperates their losses, and they can now go out into the market and buy more stocks. And so, there's a lot of us who have been arguing that after 2008, QE was a way of just goosing the stock market. It was a little hard to draw a direct line from the Fed where they printed money and how they got into the stock market. But here it's very clear, because the Fed literally can buy stocks. And then if they're buying up, stocks, bad stocks, stocks that aren't worth much money at the old price, at the old high price, and just bailing out these primary dealers, these banks like Morgan Stanley and Goldman Sachs that lost a bunch of money because in the stock market because they made bad investments, they now can go out and buy even more stocks and push the price back higher of the stock market. And so really there's no way for me to quantify, or for anyone to quantify what impact this is going to have, because of course it's dependent on what actions the primary dealers take, and of course whatever they choose to offer up to the Fed. I assume they're going to try and offload all of these undervalued stocks now, or not undervalued, these deflated stocks off their balance sheets and get cash, and then go and I don't know what they're going to do with it. They may not go back into the stock market. We don't know what's going to happen. But to me, this seems like a lot of potential for a move to the upside in the stock market, of essentially the losses that these companies incur in the stock market are going to be covered by the Fed, pretty much to infinity. The Fed really isn't setting any limit on how much money they're going to give out. So it seems to me like it's a license to go and speculate in the stock market all you want, because, hey, if everybody's doing it, what do you have to lose? And, of course, the price, if everybody's doing it, the price is probably going to get driven higher. all these primary dealers can go into the market and try and spark a rally. And so we're very much in uncharted territories here. I can't act like I know exactly what's going to happen because there's so many new things happening now all at once. But, I can also just look at the case of Japan because everything the Fed is doing now has pretty much already been done in Japan for a long time. Japan's central bank has been buying ETFs for a long time. They've been going in the stock market and buying things up. And, the Nikkei is still not doing great. If you owned if you bought stock in the Nikkei, or if you bought a Nikkei, mutual fund, because ETFs I don't think existed in 1991. If you bought a mutual fund that owned the Nikkei in 1991, you would, I'm pretty sure now you would still be negative. But even at the peak this year, I think you wouldn't have made that much money, because despite the fact that the Bank of Japan buys a lot of stock, a lot of Japanese stocks. I believe they might also buy American stocks, if I'm not correct. I can't remember exactly. Obviously, I don't study the Bank of Japan's balance sheet on a regular basis. I have somewhat of an awareness, though. But they have not been able to inflate their stock market to the degree that, say, the American stock market has been inflated since 2008. So it makes me think that perhaps a similar policy from the Fed might yield similar results here, in that it's going to fall flat on its face. In fact, the Bank of Japan, recently announced that they've lost a lot of money on the ETFs they own, despite the fact that it cost them no money to buy it because it printed money out of thin air, and they actually lost money. So anyway, since the virus panic began in earnest now, finally, once the understanding that this virus is a big deal reached the United States, things seem to have been going straight down, and it seems, at least for now, this week we're having a bit of a respite. You've got all this stuff going on in Congress. You've got all these bazookas from the Fed, and there's uncertainty, I think, in what sort of impact that's going to have on the stock market. And so you're seeing less downside volatility, less upside volatility. You're just kind of seeing things level off for now at a very low level. Remember, these are, again, below the 2018 lows. So this is pretty darn depressed, especially considering that the highs for 2020 were higher substantially than the highs from 2018. So the stock market's already fallen a lot further than it did in 2018. And I anticipate that as we move forward, even though there will be bumps in the road, we are heading lower from here. How low? I don't know. I think I've heard some people throw out the, and this is even on CNBC, so the very optimistic people generally on that network, the idea of 1,700 or 1,800 on the S&P. I think that seems appropriate. That would be, I think I looked it up, something like 60% market cap to GDP. Very reasonable. But again, if that's assuming that the virus, that all we're dealing with really is a financial crisis that can be swept under the rug by the Fed, that all the bailouts do work, and that this virus crisis ends, in short order, and that we don't, have, say, an 18-month lockout or lockdown, which is kind of what the White House is pushing now. We're hearing 18 months. People were talking about a couple weeks, couple months, 3 months, 6 months, 9 months. Now we're hearing 18 months. That could just destroy everything. I have no idea what the world looks like on the other side of this. I think I mentioned that yesterday, the 18-month number that's coming out of that the federal government now. So anyway, with that said, if you gain anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day, and I'd hate to have you miss one. So I'll see you folks back here tomorrow.